Hello and welcome to PropNext, the property podcast about all things related to the future of real estate. I'm delighted that you've joined me today. My name is Gavin Morgan, your host. If you'd like to know a little bit more about me, please check out www.propnext.com. That's propnx.com. Or drop me a line if you'd like to chat privately on gavinrmorgan@propnext.com. That's GAVINRMORGAN @propnext.com. Clifford Wong, great to have you on PropNext, and thank you very much for joining us.
It's a pleasure.
Clifford, I just like, again, with a lot of the people that I speak with in this podcast, you and I have known one another, worked together, played a lot of golf together, and become good friends over a long period of time. And I've known you in a number of different guises in the organization that you work at, but I don't think I would do you justice in an introduction. So maybe if you don't mind to kick things off, I can pass across to you to maybe give us a brief introduction on who you are, what you do, and we can then roll on to the topic for today, which is discussing real estate or equities. What's your pick?
All right. Okay. Well, I'm Clifford. I work for the Jebsen Group. I'm their CEO. I've been with the group for 19 years. And before that, I was a banker. And before that, I was a lawyer. And the Jebsen Group is part of the Jebsen family, a Danish family who has been in Hong Kong for 5 generations, started from shipping to trading business. And now with our portfolio includes the travel business. We have the Aston Martin dealership in Hong Kong. We do shipping investments. We have a service business, insurance brokerage, and other agency and representations basically in Hong Kong and Greater China.
Sounds interesting, and lots of different things to keep you interested. So no wonder you've been there for such a long time. Clifford, turning to today's topic, I'm super interested in this. But you and I talked about alpha and beta returns, and just to get us going, could you just maybe for the listeners, what are alpha and beta returns, and what factors drive returns between real estate and equities?
Yeah, so we're comparing the Nasdaq. It could be the S&P 500. So when you measure over a period, you will say, well, how far has the entire market gone up, and that's kind of the beta of that return. And then the alpha is, well, how does that individual stock that you have picked perform in the context of that market environment? For example, you can have the general Hang Seng Index declining, say, 10% over the last year, but the stock that you have picked actually has increased for 5%. So the beta of that will be, a negative 10, but your alpha will be plus 15%. I think that, generally speaking, that's how I would define it.
So it's like Clifford, would it be right to say that's kind of the spread of sort of what you might see across one of these asset classes, or is that not describing it the right way?
Yeah, you would say is the spread for that particular asset class, and then how do you measure your individual pick against that general condition over a period of time? Yeah.
Okay. Well, thank you. And just factors that, are there any common factors that drive real estate and equity betas? Interest rate. You'd mentioned interest rates and global economic trends to me.
Yeah. So I think like any financial assets or real assets, that there are factors that commonly drives different asset classes, and certainly interest rate is one big factor. When you have a very low interest rate environment like the one that we've had for over a decade, it tends to inflate the asset prices because investors demand less of the yield or the cap rate from that particular investments. And when you're demanding less of that yield, or whether it's earnings yield or rental yield, then you're willing to pay a higher price for that particular asset. So I would say interest rates definitely is a big common denominator for equities and real estate returns. The other is, all this global economic trend, with low interest rates, and globally with central bank around the whole world, most of them, when they were in the same cycle of injecting liquidity in the market, then it does tend to drive up many asset classes, including equities and including real estate and fixed income. So I think what we've experienced in the last decade plus, certainly the interest rate plays a big part in that.
For sure, and an interesting time ahead with respect to interest rates too. And Clifford, just a cheeky side question: do you think the market has priced in the anticipated impact of interest rate rises in equities and real estate? And probably a crucial part of that question is, it seems to me that it's easier for the equities market to price in and anticipate change than it is for the real estate market, that the impacts of things like that tend to linger in terms of their ultimate impact in real estate. Would you agree with that statement, or do you think it's inaccurate?
So two parts of the question: whether the market has really priced in the upcoming high interest rate environment. I think the answer to that is no, because nobody knows how far the interest rate will go. And that it to some extent depends on how far inflation is going to persist, and then the balancing act between fighting inflation and maybe pushing the economy, the global economy, into a bit of a recession. So that's a bit of a balancing act. And if the people don't know where that ends, it's very difficult for asset prices to price accordingly. So the answer to your first question is no. The answer to your second question about whether real estate tends to be, like equities tends to be a better pricing mechanism, I think I would disagree with that. Just generally because I think it's as an asset class, real estate tends to takes a lot longer time to react, because we don't have so many transactions in the market. Like equities, they get traded every second, and that whether people are overly optimistic and pessimistic, they can it's nearly instantaneously reflected in that price for that particular day, and then with fear and greed, they reverse. So you can have a very down period for a couple of months, and then things will rebound, and people get a little bit more optimistic, and then until a new wave of information comes and they react again. So I think just by nature of the asset class is just the equities tends to have a lot more noise in it, and it jumps around a great deal more. And I'm not sure whether that is the same thing as being able to price in the current whatever market environment. It's just a lot more jumpy, I would say.
Yeah, absolutely. And I mean, Clifford, I was going to ask you about key players and access to information. I think you've touched on a lot of that. I mean, I agree with you. Much higher volume of transactions at a much higher frequency in the equities markets, possibly makes it a little easier to track on a day-to-day basis than the real estate market. I think real estate requires a lot more prediction and projection to get decisions right. But it doesn't tend to turn on a dime as frequently as the equities markets. Sorry, you were going to say something there?
Yeah, I was just going to say, I think the most biggest difference when you're looking at alpha and betas and how these assets react to news is that by nature, real estate is a very long cycle asset. The demand and supply dynamics for a particular real estate class in a particular location, is driven by a lot of factors. For example, you just can't say I want to start to build a whole block of flats or a big commercial building. It takes years in the planning and then takes years or maybe months in execution and building of it, depending on the size of that. So that asset reacts a lot slower. But at the same time, the underlying dynamics of that particular asset class is also much longer. For example, you can have a commercial building that's already been locked in, most of the tenants for 3 years or 6 years. So that actually the cash flow impact on that particular building is not really going to be affected so much immediately by whatever economic news is there, which may or may not even actually affect the cash flow of that particular asset class. So by nature, I think real estate are much longer, and therefore, when we compare the alpha and beta returns, one of the argument I'll make is for real estate, it's actually much easier or much more important that you focus on that beta, that you kind of pick that economic trend, which could last for years, and be in it. I think that's probably more important than the alpha side as compared to stocks.
Yeah, that's Clifford. I think that's an interesting observation. But look, you and I talk, and I know when we talk to a lot of our friends in the financial services sector, I mean, the advice is always that I think there's a huge temptation for a lot of people to dip in and out of stocks or equities, thinking there's a quick buck to be made, and of course there is for people in certain situations. The same applies to real estate too. But I think stocks are just viewed as something that's where it's easier to get in quickly, do something quickly, and make a lot quickly. And of course, good advice around that sector will always tell you the opposite, that it's a long-term play. And the evidence and statistics prove that if you stick around in equities for a long period of time, that it tends to be a productive proposition. Provided, of course, that you've done the right research before you get into the equities in the first place. So I think there might be some more similarities between the two asset classes behind your sort of longer term, more stable proposal for people who might want to get into both. But just a thought, of course. Just a thought. I could see you nodding your head. I know we're not on video, but do you want to respond to that?
Yeah, because I think equities, stocks, is the transaction cost of going in and out is negligible, and the market is always ready, and you can have, like, when market is choppy, you can have like 10% swing, on just happening in a matter of days, whereas real estate is the transaction cost of transacting usually is much higher, and therefore it's prohibitive that you go in and out all the time.
Yeah, that's a very fair point. And I mean, of all people, I shouldn't be ignoring that in this conversation.
Absolutely. But do you agree that, for example, as a real estate investor, and also in the service sector, kind of like if we look back in the last 10 years, is probably better for an investor just to go in rather than kind of like pick the best, a project within a particular geographic location. Just the fact that, we had that big bullish trend, the fact that you go in at the timing of going in and exiting is probably more important than just being overly picking the best projects and missing out on that return. Would you agree with that?
Absolutely. I think having been in and holding for the last 10 or 15 years, of course, you need to have made relatively wise choices on the entry point, but it's produced some great returns for a lot of people. So Clifford, sort of pivoting a little bit to the future. I mean, I actually think we've probably got one of the most interesting 18 months ahead, than anything that we've seen for a while. I mean, it may not bring great news for a lot of people, but certainly it's finally going to bring to an end a long sustained period of very, very low rates, low borrowing costs. it doesn't look to me like the ability to access funds is going to ease a lot, but the cost of funds where people are able to get them are clearly going to go up. What would you watch for as you consider investment, real estate or equities, with that type of environment ahead?
I think it's interesting because, well, there are two end games. One is the scenario where, as you said, we really come to the end of this decade plus loose monetary policy and easy money, and that we enter into a more prolonged high interest rate, high inflation environment. That's one scenario. The other scenario, which I think is at this point in time probably more likely, but it's a bit murky, is that we will head into this higher interest rate environment, but only for maybe a relatively short space of time. What I mean is maybe we will have high interest rate for 12 months and 18 months, and then we're back to this game of printing. So just because politically it's just easier for governments to have loose monetary policy and to avoid recession. And as long as the headline inflation is under control, we're going to be back at that game. So in that case, we can't be too bearish and say, let's sell everything and move into cash. We just have to still stay invested and quite vigilant. That's my view.
Yeah. And Clifford, maybe one final question on that before we wrap up. It's how do we get back to, so what does the economy look like where we're printing money again, but inflation isn't being driven up like it has been over the last year or so? What does it look like? I mean, what are we seeing as an early indicator that that's going to happen?
The first thing about inflation is it gets reset every year. So if oil, gets from $90 to $100, now you get 10% inflation. Like if it's just a 10% increase in price. But for that to continue, then next year, then it actually needs to go up to $110, and then the year after that, $120. So it's not just the absolute price change, but a persistent price change over many, many years. So, and that's kind of, that's kind of difficult to see at this point in time. We see things going up, and then, factors and both economic factors as well as other factors that are into production, increase in supply tends to push prices back down again. So I think we probably will be living with high prices, and we're getting used to gasoline at much more expensive. But to say that it's going to keep going on the same rate of increase for years and years and years to come, I think that's not on the cards yet. And there are still the factors that contributed to low inflation in the last decade are still there. For example, the increase in global trade, the use of technology, the increased efficiency in technology, and therefore reduces the labor component of a lot of the services and the goods. All these are disinflationary factors that are in place for the last 10 years or even more.
Yeah.
The jury is still out.
Okay. Well, it's I think sort of proving what we said at the beginning of this little section, that it's just such an interesting 18 months ahead. And so, Clifford, last question. A horrible one for you.
Okay.
How would you allocate in the next 18 months between real estate and equities if you were going into the markets for the first time with a blank sheet of paper?
Oh, that's a difficult one. So
A nasty one, Clifford. I'm sorry.
it's easier to not start with blank sheet of paper. It's easier to just speak like where we are at this moment. And where we are is, as I mentioned, you have got to stay invested. You can't just jump in and out because there's still risk of just going naked and jumping out. So now what we do now is, I think that the right call must be is to deleverage. If you're over leveraged or you have leverage, to deleverage must be the right call, because the returns are simply not the same as before. And if you are taking on that much risk for that return, the way is to ease on the gas and deleverage, but stay invested. But that's quite different from what you're asking. You're asking if you are starting from a blank sheet of paper. So you have a lot of cash and not invested in assets. Now that's difficult. That's difficult.
Do you just stay in cash, Clifford? I mean, it supports a deleveraging theory.
No, deleveraging means that you're fully invested plus leverage. So you're just putting your gas pedal off the gas by deleveraging, but you're still staying invested, right? You don't have bank debt to fund it. You're fully, whatever assets you have, you're still fully invested in it. But if you're starting afresh with just a lot of cash and liquidity and not in the asset market, I think you're still under pressure to find opportunity to deploy, and maybe you need to still actively put maybe 20% of your asset in play by looking at what are the good opportunities. Now the prices have come down in different segments, like certainly from equities, things have come down a great deal. Also for bonds. So you've got to start deploying. You can't just wait for things to get cheaper, because they may or they may not. So I think it's still deploying gradually, but quickly get to that 20% and then keep looking every 6 months to see where the world is heading. That's what I would say.
Okay. Clifford Wong, it's been predictably good fun having a conversation with you about real estate and equities, and thank you for sharing your candid views with us on both topics and the way ahead. That's Clifford Wong, the Chief Executive Officer of MF Jebsen. Clifford, thanks again for being on PropNext with us today.
Thanks for having me, Gavin.
So that's a wrap for today's show. I'd like to thank you very much for tuning in to listen today, and hope to welcome you back to hear some of our future shows. As I mentioned earlier, if you'd like to learn a little bit more about me, look at www.propnext.com. That's PROPNX.com. Or drop me a line on gavinrmorgan@propnext.com. That's GAVINRMORGAN@propnext.com. I hope to hear from you soon, and thank you very much again for tuning in today. All the very best.